Hello, this is Brandon Christy from Christy Capital Management with an educational economic update for February 2018. In this month's video, I'll discuss some of the major headlines that influenced markets in January. I'll also provide insight into what these developments could mean for you as an investor. Please stay tuned at the end of this video for a required disclosure statement. January 2018 is behind us, and stocks posted quite a positive start to the year. In fact, even anticipation of the first federal government shutdown since 2013 did not derail the markets. The S&P 500 and Dow both had their best monthly performance since March of 2016, with each rising over 5%. The NASDAQ gained 7.3%, making January its best month since October 2015. Several details that came out during the month indicated that a strengthening economy is driving markets' performance. Initial readings of the gross domestic product, or GDP, show the economy grew by 2.6% in the fourth quarter. Though smaller than projected, the increase still implies healthy economic growth. Corporate earnings data also suggests that the economy continues to expand. During January, many companies released their earnings reports for the fourth quarter of 2017. By the end of the month, 81% of the S&P 500 companies that had shared their earnings data beat expectations, and 83% exceeded their revenue estimates. In addition to growing corporate earnings, labor measures seem to illustrate that the economy is advancing. The ADP employment report indicates that private companies added more jobs in January than analysts expected. Further, few people filed for unemployment in late January, keeping initial claims close to a 45-year low. Unemployment currently sits at 4.1% and could go as low as 3.5% by the end of the year. And wages are finally starting to pick up too. According to the Labor Department, the Employment Cost Index, or ECI, in the fourth quarter was 2.6% higher than a year before. This increase is the largest since early 2015. Examined together, you see a growing market, increased corporate profits, low unemployment, and rising wages. But this positive news is not without risks. If the tight labor market leads to faster wage growth, inflation could increase. At that point, the Federal Reserve could start raising interest rates more quickly than anticipated. The Fed met at the end of January and decided to keep interest rates the same for now. They did indicate, however, that they expect inflation to increase over the next year. After years of inflation missing the Fed's 2% benchmark, the markets would have to decide how to react to prices increasing more rapidly. Ultimately, we have strong growth in corporate earnings on one side and the potential for faster than anticipated interest rate increases on the other side. Looking ahead, we will continue to analyze the interplay between economic growth and inflation. Only time and data will tell exactly how these connected pieces will come together. But we will work to keep you informed along the way. Well, that's it for our educational economic update for this month. As always, if you have any questions or concerns about what we've discussed, please give our office a call at the number below. Please remember that nothing we talk about here is a recommendation. Give our office a call at 866-331-7749, and we would be happy to discuss your personal financial situation. Well, this is Brandon Christy with Christy Capital Management and your February 2018 Educational Economic Update.
While we believe the information in this report is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or a solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decision.